companies are going to have to document how they manage all of their cash receipts that flow in and out of the business. And this is very often called a treasury policy. So a treasury policy would clearly outline how all of the cash that the business receives and pays is managed and utilised, and this would include currency. Given the significant challenges that Brexit is going to give, I think it's critical for every business, and really they should have it done already, but it's going to be critical for every business to document a treasury policy that clearly outlines how they manage all of their cash flows that come in and out of the business. That would be the first point. The second point is we often say that, sales are for show, margin is for dough, and cash is king. So having a very clear multi-currency cash flow model will be critical for companies that clearly identifies when they're actually receiving money, when they're making sales, what their sales projections are, and how all those monies are going to flow in and out of the company that will flow back into their own treasury policy. That will be critical. And then having a very effective multi-currency cash flow model will allow them to scenario test parts of the business. For instance, pricing. So obviously pricing is going to become a key factor for companies, and it already is for many companies in terms of how they negotiate contracts and prices with their UK customers. So, is there an appetite for companies to revisit their customers in terms of pricing? Have they built anything into their contracts that will allow them to revisit pricing? Have they modelled out what their pricing needs to be, and have they stress tested these pricing models? That's critical, I believe, during this Brexit journey. Flowing from our multi-currency models that you will have, there is undoubtedly going to be a strain created for companies in terms of their working capital, because I think it's quite clear that no matter what Brexit we have, it is going to create delays for companies in their cash-to-cash cycle. And a cash-to-cash cycle is effectively from the moment you pay your supplier all the way through to the moment you get paid by your customer. And I think we're going to see a lengthening in that cash-to-cash cycle. Now, this is going to create strain for every company in terms of how they manage their working capital, because we run the risk here of companies running out of cash effectively before they actually get paid. So have companies correctly modelled what this could look like post-Brexit, and how it might look is that if we have a lengthening in terms of customs and customs delays, if we have strains in the business in terms of tariffs, what that might look like. So have we modelled this into our analysis and what that might look like? If you haven't, you could find that you have significant strains on your working capital. And there are solutions out there to solving working capital issues. There are lots of providers, but before you ever get to that stage, you need to identify what that may look like and the impact it will have on your business.